So what if I told you guys that the mortgage rate isn't actually based on the 10-year treasury like the media and a lot of people on YouTube are telling you? So to answer that question and to clear up that myth, I have my good friend here, Mr. David Bruce, who you spent 28 years in the mortgage industry, correct?
That's right.
I love it. I love it. So let's go ahead and answer that question. This is what we're going to talk about in the video. So let's go ahead and get into it and cue that intro. Hey, what's going on, guys? This is Daniel here, one half of the Kwok Brothers. And in this video, we're going to be talking about what mortgage rates are actually based on. And well, to help me answer that question is my good friend, Mr. David Bruce. And he's been in the mortgage industry now for 28 years, which is awesome because that's longer than I've been alive. Now, David, I heard you tell me and a lot of other individuals that the mortgage rate isn't actually based on the 10-year treasury. Can you provide some more explanation on that and what you're talking about?
So the 10-year treasury is probably the easiest and the most common way that people think about mortgage rates being tied to. However, it's easiest to find and easiest to track, but it's actually the mortgage-backed securities that are what the interest rates are based off of. And the thing that people don't also understand is that these mortgage rates, because they track the mortgage-backed securities, those can change multiple times within a day.
Wow.
So it's very volatile. It can go up, it can go down within a day, but it's actually the mortgage-backed securities that determine what the interest rates are, how they're priced.
Yeah. So obviously a lot of people pay attention to mortgage rates because, if you're a current homeowner, you're looking at the rates because you're deciding whether or not you should refinance. If you're looking to buy a home, obviously you're paying very close to the rates as well. But how does that work, right? So you said it's more so the mortgage-backed securities. What does the process then look like in determining what the rates actually are?
Well, the mortgage-backed security trades based on a coupon for a rate. Like now we're probably trading about on the 3% coupon. And the price goes up and down based on the bond market and the activity and the amount of purchasing within that bond market. So the rate can fluctuate, just like the 10-year treasury can go up and down within a day through a range. The mortgage-backed securities trade within certain ranges. And whenever they break out of that range, the rate can either go up or go down. Usually go up faster than it comes back down, but it just trades within that range based on the coupon or the current interest rate environment.
Yeah, no, that's very essential. So let's talk about what's happening right now. Let's talk about some current events because obviously we're seeing the Federal Reserve buy up a lot of notes. Right. We're seeing them buying up bonds. We've seen them buy mortgage-backed securities in the past, hundreds of billions of them. And, a lot of YouTubers, including myself and, a lot of media outlets have been observing that mortgage rates have been kind of going up. Right. What are your thoughts on that? What do you think we're eventually going to see in the next 3 to 6 months?
Well, interest rates have been going up since January, and it's been a pretty strong increase. It happened pretty quickly. And one of the things that's helping keep interest rates down right now is the Fed, like you mentioned, is doing quantitative easing, which means that they're going into the market weekly and buying mortgage-backed securities in order to keep the interest rates down. And it's their ongoing commitment to doing that that is helping keep rates from rising even faster. So we do feel like we're in an increasing rate environment. We have to be realistic in what we think of as far as historical terms. These interest rates are still incredibly low. I mean, we got down to the bottom of about 2.65% on a 30-year fixed, and now we're sitting at about 3.1, 3.2% on a 30-year fixed. 15-year fixed, we're even all the way down in the 1.99 and under. So historically speaking, we're in a wonderful interest rate environment. So it's not going to last forever. The Fed is doing everything they can to subsidize the market because you think of quantitative easing as being really a subsidy to the mortgage industry to keep the interest rates down, because the lower we can keep these interest rates for longer periods of time, the longer this growth pattern can continue.
So I eventually want to ask you, do you think the Federal Reserve will then continue to buy these bonds, or how long can they continue to do that?
That's one of the things that the market is spooked about right now, is because the Fed is not giving them the proper forward guidance that they would really like in some cases. They're saying that they're not going to stop QE and stop buying them, but they aren't saying how long they're going to continue to do it. And that's where the market is trying to figure out, what expectations should we have. And that's why the mortgage industry and the mortgage rate market has been as volatile as it has. Yeah,
so obviously you and I talk, on screen and off screen about how historically low mortgage rates have been, the last 12 months. But talk to us about the tip. because that's something that not a lot of Americans know about. What is the real number that people need to be paying attention to?
Right. And this is one of the most important numbers in home finance that most people don't even know what it means. So first of all, let me just tell you what it means. The TIP is total interest percentage. And that's the percentage of interest you pay based on the amount of money you borrow over the life of the loan. So as a quick example, you might have an interest rate of 2.75%, which everybody is excited about. And that's the number that the bank wants you to focus on because that's the lowest number that they can get you to pay attention to. But the number that home buyers and homeowners need to be paying attention to is the TIP, because that's the total interest percentage that you're going to pay over the life of the loan. So with a $100,000 mortgage that has a $37,000 of interest over the life of the loan, that means your TIP is 37%. So you're thinking you're getting a 2.65% rate. However, over the life of the loan, because of time balance and the balance of money over time, you're actually paying 37%. And that number is manageable. So there are things that can be done in order to help manage that. And people just need to know through awareness that what they're really paying.
So David, let me ask you this question for maybe people who are not as familiar with this industry, because you've been in it for a very long time. But why is it that the Fed buying up bonds is keeping rates low? How does that process work?
Well, it's the supply and demand. If the Fed were not in the market buying those rates right now, there would be less demand for the market. Therefore, that would affect the price. And if there's not as many buyers, that's going to mean that they're going to want a higher price. And the price is inverse to the rate.
Yeah.
So we got to have the buyers in the market.
Yeah, 100%. I agree. So, what are ways that people can then track, how mortgage rates, work? Because obviously, if we're not looking at the 10-year Treasury and we're looking at mortgage-backed securities, should we be paying attention more so to how much the Fed is buying in bonds and notes?
Well, they don't. It's really difficult for the average person to be able to track that because it's, you can watch through CNBC or some of the media, the financial media. And I would say the easiest way to do that is through CNBC. They run the ticker on mortgage rates every day. And you can watch from day to day that average mortgage rate for the 15, 30 and jumbo rates. And for the average person that doesn't have subscriptions or isn't paying for this level of data, because the mortgage-backed security data is not as readily available.
Yeah, I love it. Well, David, thank you so much for being on this channel. Any last words that you want to say to our audience members when it comes to mortgage rates and how important they are in our day-to-day life?
Well, the mortgage rates are very important to us, especially if you're thinking of buying a home. It affects your purchasing power, the amount of home that you're going to be able to afford based on a monthly payment that you feel comfortable with. So my recommendation would be is if you're thinking of buying and you're looking at it, lock that rate as soon as you can to protect yourself from higher rates and go ahead and get that transaction done.
Yeah, I love it. And if you guys have any feedback, by the way, or any comments, questions, leave that in the comment section below, guys. We want to hear from you guys. So David, thank you again for being on our channel today. And of course, don't forget to subscribe to our channel, like this video, guys, and click on that notification bell if you would like to. But thanks again, David. We really appreciate you. And you guys will see him again on future videos.